right, what's going on, YouTube? Today I wanted to go over what is the difference between supply and demand and support and resistance. And for me to really show you guys the difference, let's go back to what you find online if you look up supply and demand and support and resistance. So if you look up supply and demand, you'll find something like this, where if on the bottom you have quantity, on the top you have price. Once we have a higher quantity of an item, the lower the price of that item will be. So the higher the supply, lower demand, and inverse correlation. The higher the demand, the lower the supply will be. So it's kind of like something is exclusive, then there'll be higher demand, and if there's a lot of something, then it will be high on supply. So an example of this is like some exclusive sneakers come out. They'll definitely be on the high demand just because of its exclusivity. And something very common, like let's say water. There's a lot of water bottles, a lot of different brands of water. So since there's a high supply of water bottles, the price of water bottles has to be low. All right, so that's supply and demand. Now, support and resistance is different. Support and resistance is more like the development of liquidity. Now, I know that many of you guys may or may not have heard about smart money concepts, and that's essentially just the new way that traders are calling supply and demand. It's essentially the same thing, as just new terms, new branding of old concepts that still work today. Now, support and resistance was created by these institutions in order for you to develop, some type of sense of your security below what you think resistance and support is. So if you draw a trend line, or you draw just like lines in your chart, and you believe that they're not going to break above this, then that's just your stop loss will be right past it. And the whole intention of this is just to have the institutions have an easier time developing a lot of stop losses in the same area. So underneath this trend line is a lot of liquidity. Okay. Now, I know in this example here, it seems like the trend line worked beautifully, but believe me, if you're trading this live, your trend line will constantly be changing, subject to how price is moving. This is easy to see in hindsight, but once you're trading live, it's a much more different experience, because once your trend line could have been up here, like going up, and then price comes down, then you draw your trend line like that, price dips and comes back up, so it's your stop loss. So you see, this trend line really would have been like this. The trend line would have been like that first. Hits your stop loss. Mind you, there's spread on this, so price doesn't really stop at this trend line here. It goes a bit below because of the spread. And then you would have to redraw your trend line like this. Price dips, all of these wicks, hitting stop losses of retail traders, with the spread down low, right? And you see, that's the issue with using these support, resistance, or trend lines in order to actually enter the market. They're not, for you. These tools are not made for you to be profitable. So if we look at this example here, resistance and support, what's the problem here? Price is spiking between resistance and support. So how can we keep our account safe between these levels? It's not possible, because the whole point of this is to create a lot of stop losses. Stop loss here, stop loss here. Got hit. Up here too, stop loss, right? Got spiked up. Spread is pushing price all the way up there. Hit. You're trying to just, draw this box out. it seems like price respected this, but mind you, the spread is a thing, guys. Spread will hit your stop loss. And I know some people will keep their, stop loss way, way, way above. So that's subject to news events that, price could be here, but the spread will be pushed way farther up. So that's subject to whether you use a unregulated broker that is more likely to do that, or if there's a news event that causes high volatility in the market. All right. So as you can see in both instances, we're having price spike up and below this support and resistance. Okay. So using these concepts are not safe. Okay. So let's look at an example on the chart. So here we have AU. Now here we have the difference between supply, demand, and support and resistance. So supply, like I said, is a surplus of the base currency, which is AUD. There's a surplus of AUD USD in the market, right? So in order to bring balance into the market, we have to exchange an equal amount of dollars for Australian dollars, right? So that's what causes the AUD USD to come back down. You have to bring a balance because for each buy order, there has to be a sell order that fulfills it for, equal exchange of both currencies, right? And as you can see, once we reach this green area, right, now there's going to be high demand in AUD USD because there's less of the currency, right? There's more dollars being pushed in. So we got to balance the market out and push it back up, right, to make it even again. Now here is the difference between supply and demand, same thing as smart money, and support and resistance. So resistance, as you can see here, a lot of traders will draw this and say that, there's a safe area here where price will not break. And also below that, there's support where, retail traders could argue the same. And as you can see, in both instances, price spikes above and below this. And mind you, a lot of traders are not thinking about the spread that's pushing price way past it, and that's going to hit your stop loss each time if you don't cater to that. So here we have resistance, which seems like, equal highs, equal lows, which in a sense just creates a lot of retail trader stop losses just right below, or even, farther below, around here. And that just so happens to be the demand zone. So retail traders are, buying here, keeping a stop loss around here and getting the stop loss hit, and then price goes the intended direction, right? So same thing here in resistance. Retail traders are trying to sell each time that the market gets here. It's the stop loss, close their intended direction. But that's because they're using support and resistance and not supply and demand. Okay, so here we go. We reach the supply zone, right? There's a surplus of Australian dollars, so we gotta sell them off to balance out. But with the dollar, we create resistance here. So each time price gets here, we're gonna be selling. And despite the fact that it seems that, price is respecting this resistance, again, the spread is pushing price above this. So retail traders are selling at these equal highs, keeping the stop losses, all of the stop losses. Let's just say hundreds, thousands of retail traders are keeping the stop losses in the same area because they're all taught this support and resistance. And now look, there's even a lower resistance below this resistance. So, that's obviously because price pushed below, created support. And like I said, retail traders probably bought it up, hit their stop loss, goes their intended direction. Same with the sellers. The issue with the selling here is just that the spread is possibly hitting the stop loss before even going to their area of interest. I mean, sorry, not their area of interest, but their intended direction. Now we have resistance here, right? So again, retail traders are seeing these equal highs, keeping the stop loss near, uh, near this resistance, and their stop loss hit goes their intended direction. They could have been in profit, let's say about 50 pips, but it was just because they were catering to the common education out there, which is support resistance, which seems to be the new age of, how can I say, not the new age, but the concepts that are being commonly taught instead of, these old concepts, supply and demand, that nowadays retail traders are calling smart money. They still work today. They still work today. And it's been, the market is, subject to change based on, fundamentals. But all in all, it acts based on supply and demand, because at the end of the day, all these buy orders have to be fulfilled by sell orders. And within a range, there will be supply and demand depending on where the market lies. So whether the market is in markup, markdown, or in consolidation. All right. So I hope you guys found this video helpful. Leave a comment below. Let me know what you guys think, and I'll catch you guys later.